I would say key things to watch in the coming months are employment, as we see more and more corporates announce layoffs or reductions, as well as the actions of the Federal Reserve.
Welcome to BuzzHouse, a Baker Tilly podcast where you can hear all the buzz around multifamily housing, with all the info you need to help you win now and anticipate tomorrow. Hi, I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Gary Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Let's get started. Back into the BuzzHouse today to give some highlights from his team's quarterly report, which covers multifamily housing, among other real estate asset classes. Our guest today is Brent Maier, a colleague of Garrick and mine at Baker Tilly, who's principal and in charge of Baker Tilly's Transaction Advisory Group. Brent, of course, is a repeat guest on the BuzzHouse. Brent, again, thanks for joining us today. And we'll be talking to him today on what he and his team have observed for the first quarter here in 2023 in the multifamily housing industry, along with a few broader over macroeconomic pieces of information as well. Before we dive into that discussion with Brent, I want to give you a few legislative and industry updates. Recently, on April 19th, the Environmental Protection Agency, or EPA, released a detailed implementation framework for its new Greenhouse Gas Reduction Fund, authorized by the Inflation Reduction Act. That's the interesting thing. Garrick and I have talked a lot about the IRA, which came out in the fall of 2022, but more and more is kind of trickling out. So we're going to keep our eyes on the various items falling out from that. This specifically will invest $27 billion to finance projects that reduce greenhouse gas emissions and air pollution. The implementation framework provides detailed descriptions of program design, grant requirements, and application evaluation factors in advance of the publication of formal notices of funding opportunities. They'll come out as early as June. Of special interest to the housing industry will be $7 billion for a Solar for All competition, which will provide up to 60 grants to states, tribal governments, municipalities, other nonprofits to expand access to residential and community solar projects in low-income and disadvantaged communities. So that's a program we're excited to see, and as that rolls out, we'll keep all of you listeners in mind as well. So again, $7 billion around housing. Turning to state and local housing tax credit news, again, which Garrick and I touched on a lot, a bill was introduced in Louisiana, which would create a state local housing tax credit with an annual statewide cap of $100 million, so very significant. Under this HB 452, the credit would be equal to the federal LIHTC award and be transferable but not refundable. The state LIHTC would become effective for tax years beginning on or after January 1st, 2024, and would expire December 31st, 2029. One last piece of news, HUD recently announced the availability of $10 million in choice neighborhood planning grants, which of course are used to fund locally driven planning efforts. Choice neighborhoods planning grants are 2-year grants of up to $500,000 each that assist communities with severely distressed public housing or HUD-assisted housing in developing a comprehensive neighborhood transformation plan that meets the housing, people, and neighborhood goals of the program. Applications for Choice Neighborhoods Planning Grant funding are due June 6th here in 2023. Now, Garrick and I are excited to jump into our discussion with Brent. Turn over to Garrick.
Thanks, Don, and it's always a pleasure to hear about all those updates. Some of those are pretty interesting, especially that $7 billion Solar for All. Looking forward to hearing more about that. Brent, thanks for coming back. Again, obviously, I know you've been on here many times, but for those listeners who may not have been introduced to you from their last visit to BuzzHouse, why don't you go ahead and start off by letting our listeners know about your background and what you're working on in Baker Tilly's Transaction Advisory Group.
Sure. Thanks, Don and Garrick, for having me back on. Always a pleasure to be here. I'm our national leader for our now real estate consulting practice, where we provide valuation and advisory services to real estate owners, users, and investors typically in and around transactions or events to assist clients as part of their acquisition or reporting process with services such as due diligence, feasibility, modeling, valuations, appraisals, and portfolio strategy. Our group continues to enjoy growth in the face of a slower real estate market as we continue to win awesome clients around the country. We have some exciting things going on throughout the group, which makes it fun.
Awesome. Well, thanks for that intro, Brent. So let's dive in to our discussion. Why don't you go ahead and start by touching on where Where are we overall as an economy? Like, how is inflation? Are we looking at recession? What are some of the other key indicators looking like? And can you specifically hit on construction cost indexes?
Well, sure. Unfortunately, there's a lot of unknowns still in the market. Inflation has subsided from its high in late 2022. Employment remains strong. However, high construction costs increases over the past few years will continue to contribute to the cost of housing, including rent. Rent, though, has receded from its recent highs and has actually decreased in some markets, but is still much higher than it was just 2 or 3 years ago. Some would argue that we are in a recession, even though fourth quarter GDP grew around 2.6%, with some economists expecting a slowdown in the first quarter, something less than 2%, and some might even say we may contract this quarter. I would say key things to watch in the coming months are employment, as we see more and more corporates announce layoffs or reductions, as well as the actions of the Federal Reserve.
Speaking of the Federal Reserve, I do have one last question on your summary on the macro level. So what did the Fed do in the first quarter, and what are your thoughts about that moving forward?
Interestingly, they decelerated their rate of increase, right, for the target rate. In the fourth quarter, they increased that rate 125 basis points. In the first quarter, they raised it twice, 25 basis points each. So they decelerated their rate of increase. I actually think we would have seen a larger increase in that March timeframe had it not been for the challenges we saw in the banking industry. So right now, in the first quarter, it went up 50 basis points total. I guess the kind of concerning thing is in their March meeting notes, as well as in April, they did indicate and predict a recession was going to occur in the back half of this year. So let's stay tuned there.
Definitely. Thanks for that, Brent. Hey, now moving, over specifically to the multifamily sector, kind of reviewing the first quarter results, your report. It sounds like there are general signs that maybe for the first time in a little bit, I know we talked about interest rates and construction, but overall, the multifamily sector there's definitely a few challenges, out there. Can you be able to comment on that, Brent?
Yeah. So the challenge is the rate of increases that owners have enjoyed has decelerated or even has decreased, as I mentioned earlier. And I think a lot of that is driven by the wage has not kept up with the cost of living as well as other costs. Inflation was at 40-year high in 2022. And so I think that's posing a challenge to a lot of the multifamily sector.
Brent, just getting a few more details, what are specific trends? You touched on rent growth a little bit. What are kind of the overall specific trends in rent growth and vacancy rates seen here in the first quarter of 2023?
So rent growth is decelerating, and in some markets, like I've said, is going down. And again, it comes back to the wages, as real wage gain has actually been negative. So looking back to the beginning of this administration, real wage gain has actually decreased. And a lot of that is attributed to the amount of inflation we had in the back half of 2021 throughout 2022. And a lot of that is because of the rent increases. Inflation is coming from the cost of living, right? So through rent increases. And then also on the construction side, we're seeing these construction costs come through and the cost of living and what people have had to pay for new developments.
Got it. Obviously, Don and I work on many transactions and track a lot of things within the real estate world as it relates to multifamily especially. And one of the things, obviously, we look at the cap rates, right? They're increasing a little bit. Do you happen to have any commentary what may be driving this?
So this is a lot to unpackage. One, the transactions that we are seeing are probably not the most desirable or healthiest situation. So your best assets are not necessarily coming to market unless there's some reason you're at the end of the fund, you've got a pending refinancing or something that's driving you to transact. So I think that's part of it. I also think part of it is the uncertainty, just the overall uncertainty. The other driving factor is rent increases, which we've already talked about. The large rent increases are gone, at least for now. And we're seeing rent increases that are more in line with pre-pandemic levels. And same on the vacancy side. Vacancy is more in line with what we were seeing pre-pandemic, where we had seen that dipped to some lows the last couple of years. But vacancy has crept up And then the other factor that we haven't really seen impact cap rates just yet, but I think we will. We'll continue to see an increase in cap rates is the cost of debt. As the Fed continues to move up on that target rate, I think we'll see the cost of debt continue to increase. And I think that will have upward pressure on cap rates.
Yeah, thanks for that. It's a pretty good summary and analysis of what's likely to happen. Obviously, Don and I are constantly talking about affordable housing. And there was an interesting thing you pointed out in your report that it was the first time in 20 years that the national average of rent to income actually exceeded 30%. And you mentioned specifically the first time. So what is your overall comments around that, and maybe conclude with an overall outlook on that, multifamily in general?
Well, it is interesting, and that came out of a report from Moody's, and I think that's a factor, kind of twofold. One, rent increases and that cost of housing, which is driven largely by inflation, and then coupled with the fact that real wages, meaning $1 today, what you're earning is not worth as much as it was 3 years ago, is not keeping up with inflation. So if you look at wage increases now compared to 3 years ago, you're actually making less, having to buy more. And so I think you're having to put more of your income towards your housing. Well, that's maybe a downside. The upside is it may delay first-time purchases or home purchases. So it may also be an attribute in terms of being able to keep renters for longer.
Interesting.
Very good. That's it for the episode today of BuzzHouse. A big thanks to Brent Maier for joining the show today to tell us a little bit about what the first quarter looked like for multifamily housing. Once again, I'm Don Bernards.
And I'm Garrett Gibson.
Don't forget to subscribe so you don't miss an episode. For additional resources around multifamily housing, check out bakertilly.com. If you have a suggestion for the show, email us at build@bakertilly.com. That's BUILD @bakertilly.com. See you next time on BuzzHouse.